Hi, this is David Roberts. Welcome to another video on common mistakes made in QuickBooks. This one is we're going to be discussing loans and how to put them into QuickBooks. One of the aspects of a loan is that it is a payment that is split into two. There's principal and there's interest. What a lot of people do is they put in the entirety of the payment as paying off the principal of whatever the item is that they're paying for. Of course, this can't be correct because there's most of the time interest charges on it, and people don't account for that interest. So we're going to look at a loan for a car, and I put the details in the description because I didn't want to try and do all of this with a calculator as I'm speaking. All right, so we're going to look at a car loan for $15,000 with a loan term of 48 months at an interest rate of 3%. Now, you know, that can change. It's could be 3 years. It could be 8% interest. Whatever that is, you've got to figure that out. And usually the lender that you have will give you a breakdown of what the principal is and what the interest is. But for this example, this is what we're dealing with. So we've got a loan amount of $15,000 for 48 months at 3%. That gives us a monthly payment of $332.01. That's the entirety of the payment, but $19.51 of that every month is for interest and $312.50 for principal. This amount right here is the total amount that you will end up paying for that $15,000 car. So let's see what we need to do. All right. What you see before you here is the open write check screen. And this is how we're going to handle the payment for the car loan with the interest expense. We're going to make it for being out of the checking account. That you want to always check and make sure it's the correct bank. We're going to pay it to the order of ABC Car Loans. Put in the number and the date and all that kind of thing. You don't have to put the amount here yet. So let's start with creating a line item for the car loan, which, as we saw in the information, is $312.50 a month for the principal on that car loan. Then a separate line item for the interest expense of $19.51 a month, which both of those added together is your total monthly payment of $332.01. Now, what's going to happen is if you don't remember to do this on a regular basis and you start just making payments to a car loan, you can go back in and change the checks later to include that part of the interest expense, because you're not changing the amount of the check, you're just splitting up the amount of the check with two different accounts. Another option you have is to click Memorize, and we are going to do an automated transaction entry on a monthly basis beginning in February of the year that we purchased the vehicle, and click OK. What that does is that at this time every month it's going to pop up a memorized transaction of this car loan, and then when you pay that bill, all of the splitting up of everything will be taken care of. You don't have to memorize it, but it makes things a lot easier. Now, what a lot of clients I have done is they want a breakdown of what the interest is that they're spending on the mortgage, on credit cards, on car loans, equipment loans, and things like that. You can put an expense interest for each item, but it would be much easier if you created an interest expense parent account and then a sub account for each one of those items that the client or that you want to keep separated. That way, the total amount of interest expense is going to go in one line on a tax return, so the IRS doesn't necessarily need all of it broken down. Mortgage interest may be an exception, but I wouldn't worry about that at this point. So that's one way of doing it, but you don't want to get too complicated with your chart of accounts. So we're going to go ahead and click Save and Close. And there it is. There is the register of the car loan that you can now find in the chart of accounts. Okay? And this is David Roberts. Thank you for joining me for this video. I'll be making quite a few more of them, so I hope you'll join me for those too.